A key to understanding how the economy works and how policy works is understanding the financial system. Wall Street and Main Street are inextricably linked. In the history of humanity and the history of capitalism especially, banks are super important. Having a good idea is not enough to build a business. A lot of times it takes a lot more money than you might have. And so where do you turn? You need somebody that has saved some money that can loan it to you. So how do you find that person? Thank goodness we have banks to help channel money from savers to borrowers, to the entrepreneurs that create the innovation and make the economy grow. In the modern economy, where there's so many people and so much specialization, so many strangers interacting every day, we need banks as a clearinghouse, as sort of a way for people to do business with each other that doesn't involve meeting in dark alleyways or organized crime or anything else. So banks are the liaison between the borrowers and the savers in the economy. Now here's where I apologize on behalf of economics and finance and all the other disciplines that have confused us with using the terminology capital. Physical capital in economics, we've already learned, is that resource that is a human-made aid to production. Machines, buildings, computers, those are things that go directly into the production of stuff. Human capital is a different type of capital, and that's sort of like skills, knowledge, things that make you a better worker, a more productive worker. Financial capital is something different altogether, and that is funds from savings that are available for investment spending. Usually when you see the word capital in the news, it is relating to financial capital, but sometimes it's relating to physical capital. We just need to be clear which one we are talking about, so we'll always try to delineate the different types of capital. They're all resources, and they're all useful for economic growth, obviously. So it can be helpful to think about the way that borrowers and lenders come together in this market for loanable funds. Some people are looking for a loan, and some people are looking to make money off of their savings. So the financial markets bring those two groups together, and there's lots of different financial markets for different needs and different sizes, but we'll, for simplicity's sake, assume one market. And the reason for that is it helps us understand interest rates, which are crucial for macroeconomics. So this hypothetical loanable funds market, it's not hypothetical, but this oversimplifying it to be one market is what's hypothetical, is the idea that you have borrowers and lenders together, and they agree on the price of lending or borrowing money, and the price of those loans is the interest rate, and the nominal or current dollar interest rate, not adjusted for inflation. We can talk about real interest rate later. You want to begin to think about a good functioning financial system as part of the infrastructure of an economy. If it does not work, the economy cannot work. One of the things to remember is that if you don't have a well-functioning financial system, you won't have people saving, and there won't be room for investment. And then also, banks are higher up on the learning curve at vetting potential borrowers and lenders, figuring out who's a good risk, who's not. And so they do it fairly efficiently. Whereas if we didn't have banks, it would take a lot longer for each of us to do that. Here's a categorization of the 5 major functions that banks provide. They pool savings from many savers. This means that your $100, my $50, they all get pooled together, and there is a loan that's big enough for the entrepreneur down the street to start a small business. If the bank weren't pooling money, she probably wouldn't be able to find a loan large enough to start her restaurant. And on the saver's side, you're actually not just lending to her, you're lending to many borrowers. Banks pool your money with everybody else, and they loan it out to a bunch of different types of businesses and individuals. As we already mentioned, banks solve information problems. They can delve into backgrounds and credit. They have access to information about potential borrowers that the rest of us don't have. So they can do a pretty good job of sussing out who's a legitimate and profitable borrower. And when's the last time you paid rent or groceries? By taking the gold from under or the cash from under your mattress? No, banks are helpful for helping us process payments, helping us store our income securely, and basically just make life a lot easier. This last point is an interesting one, and it is vulnerability of the banking system. People like my neighbor that want to borrow money to start a restaurant need that money for a long time. But I'm a saver, and I don't necessarily want to be out of my money, without my money for 30 years. I actually am putting it in the bank with the expectation that I can walk in any day and pull it back out. So banks do this kind of what's called maturity transformation, in which they take short-term loans from you, your deposits, and make long-term loans to others. There's a famous scene in the movie It's a Wonderful Life where there's a bank run in which people figure out that the money that they put in the bank has been loaned out to farmers and homeowners, and it's tied up for a long time. So this is a real problem and raises the question of bank runs and the stability of the banking system. But don't worry, there's a solution. But first, a little gut check. Which of the following assets is most liquid? A home with a market value of $300,000, a checking account balance of $1,000, a 3-carat diamond engagement ring. Don't buy diamonds. A rare edition of an out-of-print book. I'll wait while you answer. And the answer? The thing that you can spend the quickest. A checking account balance of $1,000 can almost instantly be turned into spending power, or is in fact already spending power, unlike these other assets that need to be transformed first. This needs to be sold, so it's not liquid. This needs to be sold, so it's not liquid. This needs to be sold, so it's also not liquid. All right, you young'uns, here's a fancy term. Financial intermediary. Basically, that's the function that banks and other businesses take when they transform the funds that it gathers from individual savers into financial assets for borrowers. So banks, commercial banks, credit unions, etc., these do that thing, but so do mutual funds, so do pension funds, life insurance companies. They do the same thing. So we consider more than just banks are part of the financial system. And when one of them fails, this can be catastrophic for the economy. Here's the beginning of the 2008 financial crisis that brought the world to its knees. Lehman Brothers was an investment bank, meaning they take people's savings and they put it into the stock market, basically. It's into higher risk investments. Mutual funds are a little bit different. They are also a financial intermediary that basically pools people's money and then buys pools of stock. One difference is you can think about investment banks being for high rollers, large amounts of money. Mutual funds are for normal people that don't have wads of cash, and their money is pooled with other people's money, and they buy diversified sets of stocks, unlike investment banks where you can have highly managed situation. Some more terms that you may or may not be familiar with. Pension fund. This is the type of mutual fund that is specifically for retirement income for its members. And then life insurance companies, different types here, but they sell policies that guarantee payments to beneficiaries when the policyholder dies. And for those of you interested in the American style of capitalism versus other styles of capitalism, the U.S. definitely has more use of bonds rather than other types of loans. So we talk about bonds in a different video, but it's another type of agreement between borrowers and savers. And the U.S. does a lot more bonds than the European Union. Bonds tend to be riskier. So the U.S. is well known as a sort of hearty appetite for risk. And there's lots of reasons for that. One of the reasons is that we have more generous bankruptcy laws, bankruptcy protection for people and for firms, reducing the cost of trying and failing. That's an important thing. And finally, for some real-world applications, something interesting happened in South Korea. A lot of interesting things happened in South Korea. One of them is in 1965, the government reformed the banks and increased interest rates. So you want to think about what are interest rates functioning as. They are an enticement to savers, right? If you put your money in a bank, you'll get that paid the interest rate. And so a higher interest rate is good for you. And what it did was attracted so much savings that it created a big investment spending boom. So there's lots of loans to be made when there's lots of people saving. See you on the line in the next video.